Hi, I'm Mike Cintolo, editor of Cabot Market Letter and Cabot Top 10 Report, and I'm here with your Cabot Weekly Review. Well, the market had another decent week, but as the days wore on, we have seen some signs of distribution that lead us to believe that in the short term, the market could start to consolidate and some leading stocks could start to pull back. For instance, if we look at a leading stock here like Ford, which had a big run, it broke out above 11.5, broke out above 12, ran all the way up to 14.5 within 3 weeks really. Just suffered a big high volume reversal yesterday. It's probably topped out for now. There's just enough sellers at that level saying they're going to take their profits and move on. Now that doesn't mean the stock should come crashing back down, but in the short term you're probably going to see some choppiness both in some of these stocks like Ford and in the market. You can see here with the NASDAQ Composite just how far we've come. I mean, from 2,100 up to 2,400 in about 6 weeks, and there really has been no give back. Especially this month in March, the entire time. So we just feel that not talking anything big, but maybe a 2 or 3% correction in the indexes, some chopping around for a couple of weeks, and you might see some leading stocks come in. So the upshot of all this is you want to be looking to buy on weakness as opposed to buy on strength. You also want to be looking to buy on tight patterns, which I'll show you a few of. But I think chasing strength, which has worked very well for the past 3 or 4 weeks, is probably going to be put on the back burner at least for now. In terms of buying on weakness, you want to be looking for the strongest of the strong stocks, the things that have really been leading the rally, and then hopefully get them on, a pullback of 5–10%. Cliffs Natural Resources, CLF, you can see the stock has just been shot out of a cannon here from 40 to 68 almost in 5.5 weeks. It's starting to pull back. There's a couple of gaps here. Maybe you can get it down towards 60, and as I clean up the chart here, you can see the moving averages here. This is a 25-day and a 50-day. As time goes on, they'll catch up pretty quickly, so maybe a week or two from now you're able to buy it A, at lower prices, and B, at a lower risk entry point because the moving averages will have caught up. Baidu, BIDU, we've talked about before, still probably the #1 institutional stock in the market, but also probably had a short-term blow-off top here on the Google News on Monday. It's been grudgingly giving up ground since, nothing huge, but we wouldn't be surprised to see this pull back 20 or 30 more points, especially if the market has a little bit of a rough patch. And again, you'll see these moving averages just keep climbing up so that a week or two from now should appear to be a lower risk entry point. On the tightness front, you want to be looking for things that really aren't moving. Here's Intuitive Surgical, ISRG. Now, the stock hasn't done much this month, which is a small warning sign. You want things that are participating. But just notice how tight it's been between 350 and basically 360. The way you want to play these tight patterns is either buy them on a little bit of weakness or buy a little bit here, but don't take a full position until they really get up and out. You don't want to be buying full positions on stocks that really aren't going anywhere, but maybe nibbling a little bit, a small position here or there, especially as the moving averages again catch up to the stock. You can maybe take a small position and then fill out the rest of the position if and only if it breaks out. Priceline.com is another one, PCLN. You can see here, nice little breakout here, and then as the market got going in March, it had some more good volume clues. And it's not quite as tight as Intuitive Surgical, but you can see basically it's 245 to 235, this range. It's really just been bobbing around, pretty tight range, pretty low volume. Another one, Sandisk, SNDK. It's not quite the same, but you see a big move here. They upped earnings guidance. A little bit of follow through, and just the last few days, I wouldn't say it's tight per se, but you can just see it's grudgingly giving up ground. The daily ranges are getting smaller after these, big days. It's coming out of the public's eye, and again, the moving averages should catch up. So I think you want to be looking for things, the very strong stocks on weakness, and then hopefully find some of these that are tight, and then especially if the market does have a couple of bad days and these stocks remain tight, that will give you a big clue that the next major move is almost definitely up. That's all the time I have for today. Thanks for being here. Come by again next week for another edition of Cabot Weekly Review.